pretty much all of the Asian markets barring just the Nikkei, which is in the green.
Break below the low, which is the more likely scenario, which is 47,010, will indicate that the up move on the Nifty Bank is also starting to mature.
The LSE, in fact, is is cautious on both Bajaj and Eicher Motors. The Bank Nifty is the one that's taken a big hit this morning, down 1,300 points on the Bank Nifty.
If CASA doesn't grow very fast, then the spreads could be under a lot of pressure.
The industry has grown at about 14% for the 9-month period. And within that, ICICI Lombard has grown at almost about 16.5%.
The third phase of the FAME scheme, or the faster adoption and manufacturing of electric and hybrid vehicle scheme, is set to come soon.
The liquidity coverage ratio, which was down to 110% versus 121% in the previous quarter.
And markets have crashed. The Sensex is lower by 1,000 points.
One market होना ही है. तो ये आप दो मार्केट या दो प्राइस नहीं चल सकता है.
Optimism of the CEOs in India on their own ability to raise revenues in the next 12 months is number one.
The coal-based thermal capacity addition is returning back in favor.
When I look at the energy markets and how it develops, I think there is a good news for countries like India.
HDFC Bank falls over 7%. The entire banking pack is down over 1,800 points.
Well, that was a day so far, and one has to say it's not a pretty picture at all. It's a near 400-point cut still on the Nifty. The Sensex is down sharply, and I mean, you know, it's really deep in the red across the board. We are coming to you live from the CNBC-TV18 News studios. This is Closing Bell. I'm Prashant. With me, my colleagues Rima and Surabhi here in the studios. Guys, hi, afternoon. And of course, Nigel is here with us from the newsroom floor as well.
Well, Prashant, I was just thinking that markets have a way of reminding us, right? And they usually say the falls come on the most unexpected days. So you can argue that this was not unexpected because of HDFC Bank. But, on a different day, there could have been buyers on Reliance or IT. There could have been other parts of the market. But I think we had a perfect lethal cocktail, a bear cocktail. So they've decided to announce that, hey, don't forget us. We are very much a part of this market. The market is made of bulls and bears, after all.
No, absolutely. And the bears were in hiding, right? I mean, deep hibernation, actually. But I don't think the bears are back as such. It's not as if, this is a bear takeover. But it's just that it's, as you said, a combination of things coming together at once, which is what's going on here. I think that the bear word is still far out of the usual market lexicon. It's been out for a while now. Anyway, let me quickly recap the day, and I think that this table which will come up on your screen will quickly tell you exactly what we've had, right? So we started sharply lower, with the low was 21,637. It stabilized by about 11 or so, all the way till about 12:30-ish, 12:20 actually. And 12:30, the second leg of the selling started, and then the post-noon low came in at about 21,612. The 20-day as of yesterday's close is 21,622. So actually, in the afternoon, just a while back, we did break the 20-day on an intraday basis. From there has been a strong pullback. The Nifty intraday will tell you that. The point is, we basically need to watch for this decisive close below the 20-day moving average, which is the 21,622. You get that, and as it has happened, the 20-day has acted as a bit of a make or break in the short term for markets when they kind of pull to an extreme. Either on the upside or downside, and then once it breaks up or down, it extends a little bit more. So that's why I'm saying that watch for a decisive close under this one. The next support, if you want to say, well, what after once this goes? Actually, to my mind, it's only the real one is only. Then you got to start to look at retracements. The big move happened from the lows of October to the highs 2 days back. So that the first 38% retracement is only at about 20,900, which will be about 600-650 points away. HDFC Bank will buying emerge. The point is, before the numbers, everybody wanted to buy. Post numbers, it's 7% cheaper. But there's people are, of course, sitting on the sidelines, and really, I don't think there is any real reason to jump in and buy, even though valuations has been the argument here. Bank Nifty low today was around the 50-day moving average. 46,270 is that number. The low today is slightly under it, but roughly we are there. And again, here, I think you'd basically want to see if it's a decisive close below it. As we speak, we are under it by about 5 points. The next support after the 50-day is 46,140, which is the 38% retracement all the way down for the Nifty Bank. I mean, I can go on with some of the reasons, etc. But I think we've talked quite a bit about it. And the important thing is it's not just an India fall. The fall is more Asia and global markets. Hang Seng down 4% and Kospi down 2.5%. I guess all we can do, Rima, is look at Hang Seng and feel a little better about ourselves.
Or you can
we're
look
just falling 2.5% from all-time highs. That market is at 2015, 2014 levels.
No, that point is well taken, but it's the rest of the globe which is also reeling under severe pressure. Even Europe right now, if you pull up the CAC is down over 1%. The DAX is a fall of 1.25%. And US futures too, after a 230-point fall on Dow overnight, you are staring at a 120-point cut on the Dow future. So today, there is, red on the screen across the global market screen. In terms of a few places where you are seeing buying, IT is one. So HCL Tech has been a mover today on the way up. You are seeing buying in TCS, and now some of the consumer names are inching up. Pull up the intraday chart of Nestle. Nestle's stock is only up 1/3 of a percentage point, but that 1/3 of a percentage point gain has come through only in the last few minutes. Nestle is up. Tata Consumer is now up 3/4 of a percentage point, and the market is awaiting numbers from Asian Paints. So that's going to be the big one to track in the next 1.5 hours.
Yeah, I mean, I was looking at reasons behind the global fall. We have our issues with HDFC Bank, and we'll talk a lot about that. But I think globally, it was just that one comment from Christopher Waller, one of the Federal Reserve governors, who seemed to be indicating that, at least he's of the opinion that the Fed should not be cutting in a hurry, cutting too rapidly. And that was enough to create a risk-off sentiment. And it all started with that move overnight on Wall Street, US 10-year above 4%. Last I checked, it was still above 4%. So that is what has compounded the issue in terms of the global landscape. And then you had the GDP data coming out from China, which wasn't that bad, you can argue, at 5.2%. But anyway, the market was in a mood to sell off. And that is exactly what it has done. Nigel, not often that we start off with a completely red screen, but it's all red. Hey, let's be a little optimistic. On a day like today as well, the mid-cap index is actually not too far deep in the red, relatively better off.
Well, some of these stocks, dare I say, are providing great entry opportunities as well, because on days like this, you get the quantity and you get the price as well. So I'm sure there will be a lot of smart investors out there that are looking to buy into some of these stocks. But on HDFC Bank, that's the problem pocket. So I just want to make one point out there. The 100 and the 200 DMA, the stock is trading bang in the middle of both those two mark. I think 1530. I think we should get that chart up for you on the screen. 1530 to around 1570. The HDFC Bank stock, pull up the 100 and the 200 DMA, you'll see that it's trading right in the middle of that mark. But as you mentioned, the global equity market itself is in a bit of a tizzy. So let's welcome Adrian Movat, investor Hong Kong, who joins us now on the phone line. Hi, Adrian. Good afternoon from India. Well, global markets itself are in a bit of a dizzy. Well, what would you attribute it to? You have hawkish commentary coming out of the Fed speaker overnight. You have Chinese data that continues to disappoint. So what would you attribute bulk of it to?
Yeah, so I think the most important thing is to put up a one-year chart and just look at the rally that we've had since the October lows. And remember that rally was partly driven by a decline in US bond yields, which was very much driven by some of the comments coming out of the Federal Reserve. And I suppose we had on the 13th of December them changing their dot plots with, some rate cuts being put in. And maybe the market's just got overextended on expectation about rate cuts. And we're seeing, a little bit of a correction in what's been quite a powerful rally. And I put it in that context rather than, getting too dramatic over, what's a bit of price action over 2 days, if we include what's gone on in the US yesterday.
Adrian, in fact, I remember I was looking back at our chat on the 10th of January, and you had said that we need to look out for the US bond market very carefully to see the next move in the next cues. Yeah. And for what it's worth, we're back to second guessing the Fed, and now people feel maybe we won't get as many rate cuts or rate cuts as quickly. But for the time being, I just want to focus on India and on something like HDFC Bank, because you've watched this market for so long, and I'm sure you've watched this company, this bank as well. So the market's absolutely worried in terms of the time it will take for the combined merged entity to stabilize with respect to growth and deposits. I don't know if you had a chance to look at what transpired over the last 24 hours, but one of the biggest blue chip banks in India. Any thoughts?
Yeah, so look, I'm not a stock analyst, but I can see the headlines in terms of disappointment around the margins. At a strategy level, I am concerned because I think to maintain the powerful rally that the Indian market enjoyed in 2023, we need a bit of sector rotation. And I would actually argue that this is also true in the global markets, where you needed a sector rotation towards financials. And to some extent, that is actually what has driven the more recent moves in the US and European markets. And in India, we're not getting the rotation. And that does make me a little bit concerned that this rally may not have the legs that you would get if it was a more broad-based rally. So the specific HDFC news, if you project that across the rest of the financials in India, is definitely an important negative for maintaining this rally.
Right. No, I got that. Adrian, you know, some of this, you know, in the US, for example, the rally in the dollar is being talked about quite a bit. These comments which we were discussing earlier, you know, Christopher Waller there, he sounded hawkish, but is he really hawkish? I mean, I read something where, you know, March is 2 months away. And if he's saying that, he's saying, well, maybe the first cut is going to be a little away. I mean, March is a little away. I mean, I'm just saying, and our markets may be reacting a little too severely to what he said. And will they sort of come back around on this one?
Okay. Well, I think if you look at the futures market for the Fed funds rates, that, to me, is overly bullish on cuts. And that's a risk to the market. And, you know, what the future market is saying is far more cuts than what the FOMC has said on the 13th of December. And, you know, I think the story for the first half of this year is there is a disinflation trend, but the disinflation trend is going to result in an increase in real incomes, which is going to mean the consumer actually is more robust in the US and Europe. And so the pressure on central banks to cut rates will just not be there.
But is there any chance, Adrian, that we will see the dollar going back to, you know, 108, 109, 110 plus kind of levels, yields going back to the 5% levels from where it's come off? I mean, is there any case? Or you think that is a possibility?
Look, the dollar is going to strengthen. It weakened, you know, with these excessive rate cut expectations. And it's now going to strengthen as people realize they priced in 2 new rate cuts.
What's your expectation of how many rate cuts are we likely to see? Because as Waller pointed out, we may not see as many rate cuts, or the rate cuts may not be as fast and deep as we've seen in the past. So your own expectation of rate cuts this year from the Fed?
I would go with the experts and the guys making the decision, which is the Fed. And if you look at their end of the sort of median dot plot for the end of the year, it's 4.6. So that's 3 rate cuts, very much back-ended.
Okay, that's the US picture and what we can expect on the rates trajectory. Adrian, to come back to India, you know, just to follow up on the point that you were making earlier, that you sounded a bit concerned about the fact that the sector rotation is not happening, and everybody's been waiting for that. This year started off with a, you know, great promise that it's going to be a year of the banks. Not quite looking that way today as we see the screens. But, I mean, beyond this headline, what is your overall sense? I know you've been optimistic on the economy, on the growth here, but just from the market perspective, 22,000 was scaled, and now we have these issues with banks. How would you look at this market?
Yeah, I think we're into a first quarter of consolidation in the Indian market. You know, as we sort of look for the next theme. You know, it's a market that stands in incredibly sharp contrast to, say, China or some of the other big EMs, where there's massive pessimism. You know, people are optimistic about India. It's reflected in the valuations. And to be fair, you know, the Indian economy has delivered, and as have certain of the corporates. So, but I think we've got a global consolidation in markets going on as we go to a more reasonable view about the Fed. And, India will just be part of that trend.
Okay, Adrian, we'll leave it there. Thank you very much for joining us on short notice. Appreciate your time here on CNBC-TV18 as always. And it is a pleasure getting that. Well, 370 points lower is what we have. So 21,658. So, I mean, 370 points means that we're off the lows, but it also means that we're pretty much at the lows. It's neither here. I mean, it's not a decisive pullback, but we've been down that much for the last hour and a half or so. So there's no fresh breakdown, although we're already down sharply on the day so far. We'll take a quick commercial break. Up first on the show, we'll come back. We'll get you a technical perspective on both indices and stocks. Rajat Bose and Mitesh Thakkar will be with us to help us look at technicals in some detail. Stay with us.
Welcome back. 21,638 on the Nifty. It's now approaching a 400-point fall. Will the 20-day moving average support on the Nifty hold? It stands at 21,622. We're about 11 points away from that level. Pull up the contribution plate, and it's courtesy. The fall, as we've been pointing out, is on account of HDFC Bank. The Nifty is down about 400 points. Out of that, 230 points is because of HDFC Bank. So that's about a 50-55% fall, courtesy one single stock, but it's dragged down the other banks. ICICI Bank, Kotak Mahindra Bank, Axis Bank, all contributing heavily on the way down. Where do we go from here? Rajat Bose and Mitesh Thakkar are with us on the show now. Gentlemen, afternoon, and thank you for joining in. First, on the Nifty, Rajat, what would the call be? Is there an opportunity to go short? Are you seeing more downside?
Good afternoon, and thank you for having me. I would say that I wouldn't actually go short at this juncture because when it opened, it was a gap down, and there is a kind of a potential island reversal in the sense that the trading that happened on 15th and 16th, those 2 days, those two bars are actually with a gap on the way up, and again on the way down, there is a gap. So there is a kind of an island. But till such time, as you said, that the 20-day moving average is taken out decisively, I don't think we can call it a day. And more so, I would like to see, I would say that the intermediate uptrend is in danger when it falls below 21,448. That was the recent low. Bank Nifty, of course, is in a very bad situation. That it is trading sustainably below 46,500 is a problematic thing. And HDFC Bank, the way it has fallen, if it were to fall below 1,500, there would be more problems. And it would cause a lot of trouble even for the two indices, because in the Nifty, it has got a 14% weightage. If I'm not mistaken, it is the largest weighted stock. So let's see if there is a recovery in that stock. If that happens, then we may see something, some recovery. And this is not the time that you start doing bottom fishing. I did try in the morning, and my fingers are burning.
Fair point, Rajat, and thank you for being candid. Yeah, and that's the thing. That's been the unusual, part about the day, really. And I want to bring in Mitesh as well. Mitesh, this has been one day after a very long time where buying has not rewarded you at all. I mean, buyers just not have emerged. At least, you have these intraday pullbacks and then they get sold into. But today is that unusual day where it's just been down and out. Your thoughts, and how would you approach the market now?
Good afternoon. So I think I also highlighted the same point which Rajat was trying to, get your focus upon, was the island reversal. Now that's a pattern which, by rule, and you always have statistical success ratios of any such thing. By rule suggests that there could be about there should be at least the last swing which happened on the stock chart or the index chart where this pattern is formed. That should be at least retraced as a minimum, which gives you a target of 21,500, 21,450. I think we are on our way to that now. Whether we do it today or whether we do it after a day of pullback is something which is difficult to say, but I think that's the minimum which the index should do. Also is the fact that if you add, if you just look at the gap down today, it's come at a very overbought situation of indicators. Typically that would mean that this could be a breakdown gap starting a corrective movement, which we've not had since the correction which we saw in October of 23. So I think, it's been about 3.5 months kind of a rally. And now the first corrective movement, I'm still not sure whether we are getting into a proper downtrend, but this is the first serious correction which the index should see. So in case we break 21,500, which I think is the possibility I'm considering as of now, good chance that we are looking at 21,300, 350 to be tested first, and then maybe lower level. So for the time being, this market will see supply on higher pressure. A good way to trade is obviously to exit your long positions, look for stocks which are giving breakdowns or negative crossovers on averages, or sell out of the money call option. I think that's the way to approach. So for me right now, the stock calls that I have, a sell on Ashok Leyland. That's a stock which was not performing well in the last few weeks. It's been underperforming and now looks to be getting into a declining mode. So sell here with the stop at 176 for targets of 165 to about 163. And the second stock on the list is a sell on M&M with a stop at 1625 for targets of 1550. And the only sectors would be I'm comfortable going long is IT. I've been maintaining that.
Got it. Okay, all right, Mitesh, thanks a lot for giving us that view. And talking about IT, from the broader markets, you had Emphasis. That's one of the stocks that's now outperforming. It's moved to the high point of the day. Emphasis is up closer on 1.2%. I think it has a fair bit of exposure to BFSI. And if that sector seems to be turning around, as some commentary indicated, well, that could be one stock. You have LTTS as well. That's moved to the high point of the day. Rajat, you gave us a view on the index. What about individual stocks?
Individual stocks, you just mentioned LTTS and Emphasis. I would say that Emphasis is actually doing pretty good. If it were to cross its 20-day moving average, which is around, say, 2650 kind of levels, if that is taken out, then there would be some more move. And regarding LTTS, actually, I have transacted this stock very recently, so I wouldn't like to give any view. I purchased earlier, so I'm not actually, as far as SEBI regulations, I can't talk about it.
Okay. All right, gentlemen. Thank you very much for the calls. We'll come back to you to get some more perspective and some more trades on the market. Let's try and look out for any positivity. And in terms of earnings, the one company that's supposed to come out with perhaps a good show is Asian Paints. It'll be coming out with the Q3 numbers. We have Mangalam joining in with the key expectations. Mangalam, we're trying to clutch on to any possible good news, and perhaps Asian Paints will give us some of that.
Perhaps some of that, and likely in the next hour or so. You know, for Asian Paints, it's a decent quarter which is expected, largely because of the festive season that will aid demand. Remember, this time around the festive season was delayed, so that led to good performance in both October as well as November, though December was a little muted. However, be mindful of the fact that volume growth this time around will be more than value growth, because the company has taken price cuts, raw material prices have declined, and also we will see the economy range of the products doing a lot better than the premium range itself. 7.5% overall revenue growth. You're expecting revenues just shy of that 9,300 crore mark on the top line. EBITDA grows a lot more because of the moderation that we've seen in raw material prices. So 23% jump in the EBITDA. Gross margins likely to expand a lot more, and EBITDA margins also likely to jump from 18.7% to around 21.3%. As a result of which, the net profit will surge by about 28.5%. The number you're looking at is close to 1,410 crores. What is it that you're looking at in terms of volumes? 10 to 13% is what the street is working with. And again, like I said, it's the festive and wedding season demand which will do well for the company. Important to watch out for management commentary on both capex and competition.
Thank you very much for that. Some more IT stocks are seeing buying now. So Emphasis, which our guest just recommended, is up 1.2%. Again, buying emerging in the last few minutes. Remember, Emphasis gets nearly 50% of its revenues from the banking and financial services vertical, where TCS indicated that that vertical might get back to growth in Q4. So the street is hopeful that BFS, one of the pressured laggard sectors, is bottoming out, and that could, do well for Emphasis fortunes. LTTS too is seeing some incremental buying, 4% up on that stock right now, while Birlasoft, Persistent are at the day's high. We will slip into a very short break on that note. On the other side, we'll invite Prakash Diwan. We'll talk about more stocks.
Welcome back. Here with us on Closing Bell, and let us focus on the biggest news in the market today, the disappointing numbers and the disappointing internals that HDFC Bank has delivered in the third quarter. We have Abhishek now joining in for a deep dive into the fine print. Abhishek, tell us more.
Well, to begin with, the key highlight of HDFC Bank result was the sharp decline in its liquidity coverage ratio. Entire focus on the results was down to credit deposit ratio being at 110%, perhaps the highest that you are seeing in banking sector. And this is also due to HDFC Limited book with the bank right now. So another focus was the liquidity coverage ratio, which declined sharply to 110% from 121% in the previous quarter. The sharp decline in liquidity coverage ratio was due to strong loan growth, for which the bank used part of the GSEC portfolio for growth. Hence, in the near term, deposit garnering is necessary and it would come in at a cost, or bank would actually need to bring down or slow down their loan growth momentum. Either ways, the most important factor to get affected is the net interest margins for the bank. So HDFC Bank reported net interest income which was lower than our poll. However, thanks to sharp rise in treasury gains by more than 41% quarter on quarter, their top line growth or net income growth, which is known in the banking sector, was on the healthier side on a sequential basis. So what to read through HDFC Bank's number for the sector? The best of net interest margin for the sector is behind, owing to rise in cost of funds. Best of return ratios is also behind for the sector, owing to net interest margin and provisions. With respect to provisions, it is expected to move upwards, which means that credit costs will start moving up for the banking sector. Now, RBI's new risk weight asset norms will impact capitalization of many banks in Q3 FY24 results. Banks can see, sharp rise in risk weight assets to advances ratio on a sequential basis, that is quarter on quarter basis. Loan growth can moderate from current levels in the coming quarters as deposit growth is slowing down for the system. So one of the reasons for slower deposit growth could be that people are actually finding various alternates as well to keeping money rather than keeping in deposits like capital markets, etc. Brokerages remain upbeat on HDFC Bank with respect to their recommendation and target prices. They say that there are two key things to monitor. One is that the ability to raise deposits for growth and the borrowing repayment that they have from HDFC Limited, and the net interest margin trajectory on the second part. So first time in a decade, they have seen YOY decline in EPS, which sums up a disappointing quarter for HDFC Bank. Improvement in LDR ratio, that is credit to deposit ratio, by replacing high cost borrowings of HDFC Limited with deposits will be a long down process in their view. So improvement in net interest margin is critical for re-rating of the stock. All the brokerages are bullish on the stock with a recommendation of buy, outperformance, overweight, add, etc. HSBC has cut the target price to 1,950 from their earlier target price of 2,080. However, brokerage's target price now ranges from as low as 1,950 to as high as 2,200 per share for HDFC Bank. Now, in the con call, management has highlighted that their lending deposit ratio can go down further in the coming quarters for several quarters, that they don't want to grow just for the sake of growth, meaning to say that they will not chase loan growth for the sake of it. They will have to replace the borrowings with deposits and grow further loans with deposits as well, indicating that deposit growth is the key for bank ahead. Back to you.
Abhishek, just to, what you're saying is that the hurdle rate for people to put money in banks because equity markets are doing well. One of the things you've said is that, money is moving away from bank deposits into things like equity markets, etc. Because returns obviously are much higher. Is that happening is that the suspicion at least?
Along with that, also the fact that real estate bookings, take a look at that also. There are alternates apart from deposits that customers are finding today. So hence you are seeing a deposit rate actually, or deposit growth rate actually declining. It's about 13-14% on a YY basis versus the, loan growth of around 19-20% on a YY basis for the banking sector. So the CD ratio or credit deposit ratio for the sector is around 79%. 79.5%. So for further incremental growth, you would need deposits, and that is hard to come by.
And deposits, if you wanted to come by, then you have to pay more. I mean, the cost essentially increases.
We are in the best of, highest interest rate cycle.
Yeah.
Already the lending side, the yields are priced in. So for further deposit garnering, you will have to sweeten the deal, which means you will have to pay extra to the customer to get their money.
All right. Abhishek, thanks very much for that. So, we say that markets do well, HDFC Bank will do well, but saying that if markets do well, HDFC Bank
actually suffers.
Maybe it suffers, right? And money is finding, obviously, chases the highest returns.
But there's a lot to this narrative as well. I mean, we've seen a lot of market experts point this out as well, because there is money moving to real estate. People are buying houses. So the propensity to spend more, that gets crunched. And one explanation for also the fall in, let's say, the consumer staples demand, it not being as robust as earlier, is perhaps that when people are actually spending more and buying their first or second home or third home, there's a little bit of a cutback that you have to do on those spends. And perhaps a cutback also on the money you can keep in bank deposits. Perhaps it really ties in. Abhishek, thank you very much for that. Let's bring in Prakash Diwan into the conversation. Prakash, hi, good afternoon. And what an afternoon it's turned out to be. Dive straight in on this HDFC Bank debate. Is this a great time to buy, or is this a point of concern? And is this a bit of a red flag for the sector as a whole when it comes to mobilizing deposits to fund all that growth that the market wants to pay for?
Good afternoon, Surbhi. So let me take each of these three questions separately. So first and foremost, is it time to look at HDFC Bank with a little bit of more grace and in a benign way, given that it's already lost 7%, probably more now? The whole question comes down to what is it that your time horizon is for HDFC Bank's expected revival of sorts. And, this is the second quarter after the merger. And very clearly, the management had started managing expectations by that, conference that they did, analyst meet that they did, where they mentioned all the issues that were likely to come up at some point or the other, as the migration and as the integration progresses. From that perspective, it would probably still be a couple of quarters away for them to be able to get over that. In the meanwhile, should be, this discussion that you, Prashant, and Abhishek were having on availability of money. The basic indication is very stark, and that is the savings rates have been coming down. It's not about money going out of deposits into some alternates, which is such a pressing thing. The absolute pool of capital saved is actually shrinking. And until that, is not kind of understood or factored into the growth expectations for most banks, it remains an issue for the rest of the banking pack as a whole. So I don't think this is something which is such a big thing only for HDFC Bank yet, but it probably is going to be the norm for the entire banking sector, because the credit growth expectations are very high. Everybody wants to start growing rapidly, given the kind of capital formation that's underway in the country. So, there are lots of vectors to it. But if you have the faith that a bank like HDFC, which has done tremendously well in terms of expansion, will start benefiting out of a shift from some of the other alternatives where the money is going to, and it comes to them, you could see them make a comeback very easily. So I wouldn't believe that HDFC at 15.50 is not a good bet, but it all depends on whether you're willing to give it another quarter or 2 quarters. So markets always need an excuse to correct, and today we've seen that. And once you lose 250 points, the next 150 points actually is thanks to the kind of downward spiral on so many other algos and some of the other rule-based trading that takes place in the market. So I'm not surprised the market needed a little bit of a reminder that you could not have all up days. There could be certain days where it could do a reality check for us.
Okay, all right. Prakash, hi, good afternoon. I wanted to ask you your view on Minda Corporation as well as Precall. Both those two stocks are in focus, and I'll tell you what's transpired in the last few minutes. There was a large trade that took place on Precall. And I think we should get the intraday chart out there. The deal happened at around 340 odd, and the stock is at 360 post that deal. The one that's got excited though is Minda Corp, because the street is coming to terms with the fact that Minda Corp could be part of the seller, so they'll be taking some money home. Prakash, we recall a year or so ago, Minda Corp put close to around 400 crores in Precall. And if they have sold the entire stake today, if in case it's the entire stake, Nimesh will give us further clarity on that, then they could be taking home a profit of 250, 300 crores. How would you approach both these two stocks, Precall as well as Minda Corp?
So, good afternoon, Nigel. So we'll of course have to wait for the details to come out to make a more weighty kind of a decision. But what seems like have happened, and this was on the cards of sorts for some time, is that Precall was trying to defend itself and not give in to that takeover of sorts, which was looking very imminent at some point a few months back, a couple of quarters back. And of course, Minda Corp would have cashed in on that if they've decided not to kind of, do anything beyond just buying a stake as a financial investment. So, it's of course a win for Minda Corp to have realized a much higher value than what they've acquired the stake at. But for Precall now, it will probably be an opportunity to be able to do something which it has been talking about doing in terms of expanding and rebuilding itself beyond its conventional business, which was expected to be sort of a ebbing business, and that's where I think the market will probably start looking at. So I'm sure Precall has enough salience. There'll be enough buyers. There'll be some very serious, good long-term buyers that will look at Precall differently now. But we'll of course wait for details to, as I said, to make that. But both of them seem to be in a positive space if this has happened. If this has actually happened, if Minda's sold the stake that it had in Precall.
Okay, all right. Actually, let's just dive in here a little bit more. Nimesh, of course, is the one who picked up these exclusive details on the block deal, which with regards to Precall. He's with us on the phone line. Nimesh, tell us, give us the details.
So, Prashant, as you flashed as well, what I understand from sources in the block deal today in Precall, Minda Corp, which chose to own a large stake in Precall, and they were looking to, at one point in time, take over the company as well. They are the likely sellers in today's block deal. But apart from Minda Corp, I understand there was a large private equity investor. Even they have sold out. So technically, it's a clean out trade, is what I understand from my sources, that both Minda Corp and the private equity investor has sold out completely their stake in Minda Corp in a block deal today. In terms of buyers, I think it's a long list of buyers, which includes the domestic mutual funds, a couple of insurance companies, in domestic insurance companies, and some large FI investors also buyers in today's block deal in Precall. So, as I said, it's what I understand from my sources, it's a clean out trade. Minda Corp has sold out its entire stake along with a private equity investor and some domestic funds and FIs are buyers. So, if you just recall, I guess it was a year back when they bought close to 15% in two tranches in Precall, and prima facie, I've just looked at the rough numbers, and that suggests me that maybe Minda has managed to net of tax would have gained almost 300 to 400 crores through this deal, wherein Minda has sold out its complete stake in Precall today.
Okay, all right. Thanks very much for bringing us up to speed on that stories that obviously that merges off and Minda's back to selling down some of its stake. Thank you, Nimesh. By the way, look at the market. 20 DMA on the Nifty is distant memory. The fall just keeps gathering more momentum. Now the Nifty is down to 21,575. So 20 DMA has been broken decisively. The Bank Nifty is looking at a near 2,000 point fall now. 1,960 points to be precise. So this is gathering a lot of momentum on the way down. The next zone, and Prashant, weigh in on this. I remember the consolidation of January, that brief 2-week consolidation, the market spent a lot of time around the 21,500 zone, between 21,450 and 500. So I'm guessing a lot of people will be watching that zone to see if at least, that can serve as a support, and whether we finally decide to, the buyers come back in and decide to lift this higher. But right now, this is pretty heavy on the way down.
The Bank Nifty is, as you said, right, is the weaker of the two indices. Yeah. And I wish I could put a camera and show this this chart. The rally basically started in October, right? October low on the Nifty Bank was 42,105. And from there, it had a non-stop rally. The high was made on the 28th of December for the Nifty Bank. That high was 48,636. As of today, with this 4% fall, we've essentially touched the first retracement, the 68.2% retracement, and we've had a bit of a bounce. The low today, by the way, is 46,155, and that retracement is okay, we missed it by 10 points. I can't see it very clearly because it's a slightly longer time frame. We missed it by 10 points. It doesn't matter. I mean, we basically touched it for all practical purposes. 46,142 is that level, and we got to 46,142. And of course, there's been a bounce since.
We're not taking a break, I think, because Asian Paints numbers.
Asian Paints numbers are coming through. So we got what, 1475 crores in profits, and I think it's largely in line, maybe a little better, at least on the profits, and revenues seem to be slightly better, slightly below.
Lower.
9100 crores compared to about 9300 crores, which was the revenue the expectation on Asian Paints. So numbers are coming through from the largest paint maker. Domestic volume growth at about 12%. Mangalam should be with us. We just put out the preview 20 minutes back. So we'll have the review with Mangalam.
So volume growth is in line because he was telling us it should be about a 10 to 13% volume growth. So volumes appear to be in line, but there is a little bit of a miss on the revenues. I think we have Mangalam with us. Mangalam? Okay, we'll get to Mangalam in just a bit. So those are the numbers that we have. 9,104 on the top line, missing street expectations by about 180 crores. So that's about a 2% miss on the company's top line. Though the volume growth has come in line with street expectation, and EBITDA margins are ahead of the CNBC-TV18 poll by almost 130 basis points. So there is margin expansion, solid margin expansion. The company's margins are 22.6%, compares with 18.7% a year ago. Mangalam is back with us. Mangalam, weigh in. Looks like a bit of a revenue miss, though the other parameters, volume growth, margins, profits appear to be in line.
Well, these are good numbers coming in from Asian Paints, notwithstanding the miss that we've seen in the top line. And that's largely because raw material prices have perhaps fallen a lot more, and the company has passed on those price cuts to the customers itself. And as a result of which, the realizations of paints have declined. On a year-on-year basis, decorative paint value growth has been 5.5%. The street was working with a number of about 7.5%. But despite that, the volumes have grown at around 12%. What's interesting is that despite the company having priced the products lower and having passed on those price cuts, the gross margin expansion has been around 500 basis points. That's a little higher than what the street expected. And as a result of which, on the EBITDA itself, there is a bit of a beat. It's come in above 2,050 odd crores versus street expectations of just under 2,000 crores. What's more important, however, is the commentary that the management has spoken about, where demand was subdued in the second half of the quarter. Pre-festive season was pretty good, and they are expecting double-digit volume growth to continue in the second half of this year, with margins between this 18 to 20% band itself. So, irrespective of the weakness that we're seeing in the top line because of lower realizations, I think the internals for Asian Paints look pretty strong. The stock hasn't recovered from the lows, largely because the street is now awaiting what happens in the next couple of quarters, where all the other players, including the likes of Grasim, roll out their products to the shops.
Yeah, well, it has spiked quite a bit from the first dip that came in when the market kind of was fearing the worst, seeing that top line miss. But given the volumes, given the margin expansion, I think it's a recovery, but not quite in positive territory. We have Naveen Kulkarni, CIO at Axis Securities as well, to join in and sort of comment on this. Naveen, what do you think? 12% volume growth, very smart margin expansion. What's the view on Asian Paints now?
Yeah, the numbers look good to me. The revenue growth is probably slightly lower, but that is on account of the input costs being passed on, lower input costs being passed on to the customers. Overall, margins are expanded higher than what we were expecting. Profit numbers are definitely pretty strong. So overall, I would say that these are good set of numbers. Asian Paints at this juncture, I would say, looks good to me, primarily because the stock hasn't done much over the last 1.5 years. So multiples which looked optically very, very high are now much better than what they were. And of course, it's a sector which continues to deliver, or a category which continues to deliver double-digit volume growth, which of course in the whole consumption space is kind of rare now, right? So overall, operating numbers look good. Asian Paints looks good to me.
The company said margins have gained significantly from growth in luxury products and softening of raw material prices, coupled with operational efficiency and sourcing efficiency. So there is a growth in luxury products, which is aiding the company's margins this time. Naveen, weigh in on the valuations of Asian Paints. How does it compare with historic valuations? Are the valuations a bit of a concern?
Yeah, so valuations, of course, for Asian Paints had run up a little bit. So that was a bit of concern. But we have had a significant period of time correction which has happened. So almost it's been a little more than a year where the stock has been at these levels, right? So the time correction has played its part. Still, overall valuations from a long-term perspective are still a little higher. But of course, they are slightly coming down. So comfort in terms of valuations is building up. I see absolute upside from current levels for Asian Paints over the next 12 months. Maybe 10 to 12%, but I think that's something which can very easily materialize for Asian Paints, considering management believes that double-digit volume growth is going to sustain for the second half of this year, and overall category continues to be very, very strong.
And in the paints, entire listed universe, which one would be a preferred bet?
Yeah, so from the listed universe perspective, considering that there is going to be some bit of disruption which could take place in the category, so I would still stick with the leader, Asian Paints, because the chances of the second order or the third order players losing market share in the short term could be higher. But Asian Paints, being the market leader, has got better capabilities to defend its market share. And also, paints as a category is a long gestation product, right? So from that perspective, Asian Paint still stands out for me. And if one wants to look at this category, I think this is the stock that one can allocate capital to.
Okay, all right, Naveen, we will leave it on that note. Thank you very much for joining in and giving us your perspective on those numbers and the stock. We will take a quick break, come back on the other side and get a conversation going with Aman Chauhan, fund manager at Abacus Asset Management. Find out how they're looking at this big fall and what the strategy is in the market now.
Okay, we've got the market, which is down, 450 odd points. and we are now below the 20-day sort of simple moving average. You know, I just what I just looked at is the last 3 instances when the market broke the 20-day moving average. These are short-term sort of indicators, but the last one was in August of 2023. Back then we had a 4% decline. I mean, from the point that the 20-day went and then the subsequent low, it was a 4% decline. December 2022 was the one before that. You know, back then that was a much steeper decline. I mean, the environment was different. There was a 9% decline from the level where the 20-day went to the low, subsequent low. And then you have to look at September 2022, the prior one. It was a 5.5% decline. So, you know, anything between 4 and 9%, just 3 instances maybe we could look at. We've looked at this kind of data before, but what it always tells you is that some of these indicators, short-term indicators, are useful to mark short-term turning points. I mean, they're not long-lasting, but they do give you a meaningful move. I mean, the levels stretch a little bit on the downside or the upside. So, I mean, you know, keeping those kind of numbers in mind, if you, on the Nifty, for example, I was saying that once the 20-day goes, the next kind of broad support zone is around the 2,900 level. That's about 3% from where we are right now, which is actually, which would be entirely consistent and on the lower end as compared to what we've seen in the past. So let's see if we do get something, you know, in terms of what we've seen, which would be, I mean, quite okay. I mean, you know, 3, 4, 5% pullbacks. We're not used to it, but go back in history, I mean, it's par for the course and up moves. Aman Chauhan is with us, fund manager at Abacus Asset Management. Aman, good to have you with us here. Thank you very much for your time. Just your views, Aman, with this correction that we have on our hands. And, you know, the fact is that it's banking which is contributing to the bulk of the sell-off today.
Sure. So I think just a one-day move, nothing much to read on it, except that the markets were overbought. We had a very strong performance over the last few weeks, and the market just wanted a reason to book profits, and it came via the HDFC Bank results. So nothing much to read into it. Nothing much has changed, except that one result was not in line, and it was an overbought market. So we can't be rallying all the day non-stop. So that's just one of those days when the market is correcting and booking profits. That's what we are reading out of.
Aman, what about the fall on HDFC Bank itself? Is it appearing a bit excessive? We already had the provisional numbers. We knew the kind of deposit mobilization the bank has done. But today you're staring at an 8-9% fall. So is the fall a bit overdone, according to you, on HDFC Bank?
Looks like the numbers are not as bad as to warrant a 8 to 9% move, that too in a single day. And not much materially has changed, except that the outlook on the margins is now slightly lower than what it was prior to the results. So definitely it looks on the excessive side.
Right. Hi, Aman. Good afternoon. Nigel on this side. Aman, out of the portfolio that you're managing, how much of the money is towards banks? The reason I ask this is because, yes, HDFC Bank, it appears a bit of a disappointment for the street. The problem is the read-through is still deposit mobilization seems to be a problem, which could keep the NIM suppressed for a longer duration. And if that happens, then some of this valuation argument could get pushed back. What's your view? What's the current exposure and how would you approach the banking space?
So we will be roughly around 25 to 30% exposure into financials, but that includes everything: NBFCs, banks, private as well as PSU banks, and some non-fund based financials also. And that's what broadly what the exposure is. For us, we continue to like the private banking space and the stronger NBFCs, and that stand doesn't change.
Okay, Aman, God, that's why you're not in the camp, obviously, that's getting a bit concerned, seeing this as more than a one-quarter issue, because to sort of press Nigel's point further, I guess what a lot of analysts today are talking about is just, you know, how will they mobilize these deposits and whether this is going to be an issue that will take a little longer to fix.
So ultimately, it's simple that they have to garner deposits, and that will happen through some hit on the margin. So they have to maybe give a better rate to garner more deposits, and that will have a near-term impact on the margin. So ultimately, that is what is going to be. That's what I said. Ahead of the results to post-results, the main thing which has changed is that now we are heading towards a slightly lower margin assumption for HDFC Bank than what it was before the results. And I think in a quarter or two, the street will, as well as the valuations, will adjust towards that, and post that, it should be back to normal
So got that point. That's a view on banks and financials. Let's talk about the other major pillar of the market. Now, we had those 2 solid days, right, after the TCS Infosys numbers, 2 back-to-back days of intense buying on IT. The question is whether that was the celebratory sort of 2-3 day pop, and now we're back to looking at, questioning the more sustainable growth rates, or do you think IT can really provide a meaningful, leg up from here? And in your portfolios, what's your positioning right now on the services technology?
So you can say we are neutral on IT. We would have high single-digit exposure on IT, and that has always been the case of the last 2-3 years where our IT exposure has been. Even now, we would have a neutral stance. It's still 1-2 quarters away before the growth rates materially start to look up. Even this quarter, numbers were not great. They were in line with expectations. Expectations were low, and the company happened to deliver or marginally improve on those expectations. It was more of a meeting expectations rather than giving an absolute growth or giving an absolute reason to rejoice. Having said that, there are other technical factors also. IT had not performed the whole market and moved out. There was some valuation re-rating pending. If Infosys is trading around 20 P multiple, 20-22 multiple, that's relatively much better than buying a 30-40 P stock, right? So there are many other factors which come into play besides just quarterly numbers or besides just earning. And I think that has played out in IT. So it was a relative underperformer. There was a catch-up rally which was pending, which happened. And I think another at least 2 quarters before we start to see the numbers coming in. So the first movers in IT who don't want to wait for another 1 or 2 quarters and are pretty confident that is going to happen, that there's going to be a recovery and there are going to be rate cuts, which ultimately will feed into the IT spending, have started buying IT. The relative underperformer chasers also started buying IT. People like us who already have an exposure would prefer to be very selective. So we would have added a new IT name, a small exposure in the last month or so, but we will continue to be selective. Wherever we see growth picking up, wherever we see a good earnings visibility in IT, that is the stock we would bank on rather than just looking at relative underperformance or outperformance.
And how much is it of the portfolio, you said? You're neutral, that's the stance. And how much does it weigh in the portfolio right now?
It will be high single digits in most of the portfolios.
High single digits. Okay, got it.
Aman, I know timing the market is impossible, but we are in a kind of market where markets are at all-time highs. The question is what to buy. Markets fall a little bit. The question is what to buy. So my question is, should one be prepared for a bit of a sort of cooling off, sideways kind of market? Do you get that sense? You've seen markets for a long time. What's the view at Abacus? What are the discussions like? Yeah.
So we have very strong few months, especially since April. It's almost been market on a roll. So a few months of flat performance shouldn't be a surprise. That can happen. There can be definitely a time correction that we feel. We are not unduly pessimistic or worried that we can see a sharp fall in the market. We don't see any reason for that to happen. At the same time, the forthcoming general elections are also known. It's not going to be a surprise if the ruling party comes back, right? So markets will run up ahead of that. They are not going to wait till the elections. Some of that move has already happened. A bit of news, I think, pending, which can happen, but not necessarily in this month. It can happen in February, March also. So that's broadly what the market setup is. And hence, as you said, can't time the market. So just focus on stocks, focus where we see things improving and invest into them. So that's the stance which has always been and I think continues for even now.
You've been bullish on the entire engineering space. Is that correct, Aman?
We are, but valuations are north of 40p, so we don't have much of exposure into the portfolio. But as a view, yes, definitely we are positive.
So, did you bring down your exposure to any of these engineering, companies because of the run-up that we've seen and higher valuations?
Not much. So, the companies that we own in this space, overall, we say a high single-digit to mid-teens kind of exposure into capital goods or engineering stocks in our portfolio, and we are maintaining that weight. So, the stocks that we have are relatively much better valued versus what the leaders in the pack would be, and hence we are continuing to own them. I don't think there's not much of new stock that we have added in the sector. Okay,
got that. Any other broad sectoral theme? Pharma, for example, came back into the mix recently. Anything where you're reasonably more optimistic for return generation?
Pharma definitely looks positive. We also have a positive since last at least 3-4 months now and continue to stay positive on pharma. EPC companies are looking good. Infra plays are looking good. Financials is anyway everybody's favorite. So we also in the same camp. That segment is also where the risk reward equation seems to be favorable. So these are the sectors that we are looking at. Cement, it's a wait and watch. We feel cement can give a positive surprise. So that's something that we are positively looking forward to.
All right, Aman, we'll leave it there. Thank you very much for joining us. Great speaking with you here on CNBC-TV18. It's always a pleasure. It's a bit of a down day today after some time. Well, let's cut across to the World Economic Forum, Davos 2024, where my colleague Shireen Ban is in conversation now with Salil Parekh, Managing Director and CEO at Infosys.
Conversations continue here in Davos 2024. Joining me now is Infosys' Salil Parekh. Salil, many thanks for joining us, and it's great to have you here joining us in Davos. You've probably had a bunch of client meetings already over the last 2 days that you've been here. What's the mood that you're picking up on? What's the temperature like?
So first, thanks for having me here, Shireen. Wonderful to be here. The client meetings are just extremely good, very positive thinking from most of the clients. Economies in Europe, US looking like they're coming to maybe not yet in terms of full recovery, but at least they see their work behind them in terms of what the issues were. Of course, the conversations are positive, but we want to make sure we see that translated into what we do in terms of digital programs.
So the mood is positive. Is this better than what you were expecting? And what does that indicate in terms of their ability to go out there and spend? Because that has been the key concern.
Right. So we've not seen a change in clients starting to put digital programs in yet. But the way the discussions are going, there's a lot of interest in all of those conversations. There's also interest in cost and efficiency takeout. And then there's, of course, a very strong theme on generative AI, which is all across the World Economic Forum.
But it's still wait and watch then, largely.
Yeah, so there's no new change from what we saw in the quarter, which we announced last week for Q3. It's not that we see new programs immediately starting, but what I find is the way clients are discussing things, they have a positive frame. You know,
let's talk about the quarter, Salil. And of course, you did speak, but we didn't get an opportunity to really go dig deeper into what could have led to what has been a fairly difficult FY23 for you. And if I were to just take a look at what's happened in the year, 2 guidance cuts, 1 tightening, you started with 4 to 7%, ended at 1.5 to 2%. What would you attribute this to?
So there, the main things we saw, as you might know, in Q1 and Q2 were where we saw the digital programs not becoming part of what clients were doing. So most of the focus was on cost and efficiency, automation, lean programs. That part of the business was doing well. And then if you look at it from an industry perspective, financial services, telco, high tech, that's where we saw most of the impact. Whereas manufacturing, life sciences, these industries were doing well. And then if you look at in Q3 specifically, Europe was growing quite nicely, and US is where we saw the impact. So those were the dynamics as we came into the year. Now, we do have to keep in mind the previous year we had 15% and the year before 19. So we had already a strong base that was coming in. And now we see a real focus much more on cost takeout, efficiency that's been going on, and many more discussions on generative AI.
So, you know, as far as generative AI is concerned, it's very hard to make your way around Davos without having a conversation around generative AI. But in the near term, realistically, what is it going to mean for you as a company? You know, I was just talking to the global CEO of PwC, and he said we're overestimating, perhaps his view, in the near term, the impact and the implications of generative AI, and perhaps underestimating it in the long term. But how are you reading that at this point in time? What are you doing about it?
So there, our sense is every client is looking at what generative AI can do for them. And there are already, yesterday we had a discussion where I heard a large company CEO talking about tremendous benefits they've seen, for example, in customer service area. We've seen benefits in software development using large language models. So the benefits are there. Now the question is how the scaling is going to come. Our approach, we've shared before, is what we call the narrow transformer approach, which is really focused on the data within a company. And there you get tremendous benefits and potentially less impact of hallucinations and so on. So we think that will really accelerate. We don't have a view on what the trajectory of that is.
But what could it potentially be, and what kind of investments would you need to make in order for you to be able to beef up the capabilities on this side?
So for us, the investments are massive. You know, we've ourselves positioned as an AI-first company, so we're using all of these things inside. We have assistants, AI assistants now for each of our functions, whether you look at HR, recruiting, sales, delivery. So that is a transformation inside. We have 100,000 employees trained on generative AI, different large language models, and on various ways to look at the data architecture, which is going to become the key. So our investments are huge. Topaz, our AI capability drives all of this. We now have to see, you know, what is the speed of adoption that different clients will look at and different industries.
And that's what I was getting at. Where do you believe we're going to see an accelerated pace of adoption? Are there any sectors in specific where you believe that the conversations are far ahead and maybe somewhere it's still incipient?
So here, the discussions are in each of the industries, but the overlay is still where clients are not spending on transformation programs. So my sense is what we were driving with digital transformation, with a cloud foundation, will be now enhanced with an AI or generative AI transformation. So when that, by industry, as people start to look at the ability to spend, this will start to come back.
You know, so if the mood is cautious, it's still wait and watch, and you believe that the spends will be largely on cost efficiency and not so much on the transformation kind of deals that you were hoping for. What could that then mean as far as margins are concerned in the near term? And when do you realistically expect, you know, your peers are talking about a pent-up demand situation playing itself out. Do you see that as well?
So a couple of things on that. First, on margin, we put in place several quarters ago a very comprehensive program on margin expansion. And that in part has given us the underlying strength of the margin even in Q3. And even as we go ahead, we've got detailed views on 5 pillars, various tracks, a big mobilization. So my sense is that is going to give us tremendous benefit. And in this sort of an environment...
How would you quantify tremendous benefit in terms of margin expansion?
It'll be quite large, is my sense, because the way we are working on it in an environment where cost efficiency for clients is paramount, and where growth was not as visible, we've taken the opportunity to make our operations more efficient. So we see that as a real change in the way we're running the business. On the second part, I don't know, I think you mentioned about the pent-up demand. Yeah. My sense is there is a need in companies for this sort of a transformation. The question, at least in our minds, is when clients will start to see that. And we are not, at least we don't have a guess on that, but we'll see it when it happens.
You know, TCS talking about green shoots in BFSI, is that something that you're seeing as well?
We have no. So what we commented on was that the environment remains similar to what we saw in Q2, neither better, neither worse.
You know, you talked about the efforts underway to expand margins. In light of, you know, the experience of FY23, which, as I pointed out, has been a tough year, any other course correction, any other changes that you're likely to make or are planning to make?
So in terms of changes, firstly, the margin is more an evolution. So not really a big change in direction. We always have a high margin approach. Our strategy, I think, is firmly in place, which is focused on digital, AI, cloud, cost and efficiency. A big focus on really large transformation programs or large deals, which we had 3.2 billion in Q3, 70% net new. So we see good strength in that. And then continuous focus on making sure that our margins are in good shape and really elevating our brand. We've, you know, have now Rafael Nadal as a brand ambassador, IGA. So it's really taking us to a different level with the way we are showcasing what Infosys is doing.
You talked about deals, and there was a cancellation announcement that came in of an MOU, and I know that you said that you will not comment any further on that. But what seems to have gone wrong there?
So there, as we had shared in the announcement we made at that time, the MOU was terminated, but there's no other sort of additional comment from our side there.
Okay, let's talk about what we're seeing happen as far as the talent wars are concerned, and there's plenty going on in Indian tech at this point in time. A couple of your former colleagues are here in Davos in new avatars, starting out new innings as well. Is that a concern? Senior exits at the leadership level?
No, first, I think all of our Infosys leaders are fantastic, and I'm really delighted. They're good friends also. They're really delighted they're in those roles. We are fortunate. We very quickly put together the structure where a lot of people from within have moved into new, larger responsibility roles, and that seems to be working really well. My sense is we have even today a really deep bench of leadership people. So I don't see any real concern. In fact, there's a huge energy, and sometimes with change, you get some new focus and attention as well.
So on that front, I mean, are you reviewing or re-looking, at the way that your leadership roles are at this point in time, given the exits?
No, we announced that maybe 6, 7, 9 months ago. So it's all done. There was no change in the structure. The same structure, a very strong focus on go-to-market with industries, very strong delivery organization, and these are individuals who've been with the company 20, 25 years. Very strong Infosys approach. So really fortunate to have that.
What is unusual, and it's playing out across different companies differently. We've got Wipro that's suing Jatin Dalal, and that matter is now in arbitration. We understand that you've written to Cognizant about a no poaching sort of informal agreement. What's going on as far as these talent wars are concerned?
So I read some media reports about that. So no comments from our side on that.
So you haven't written?
No comments from our side on what I read in the media about it. But I know I also saw some sort of company suing another company. I'm sure that goes on.
So, if I were to ask you to give me a sense of what you're going to be prioritizing as you look at the year ahead, both in terms of opportunities and, of course, the risks that you are going to grapple with, what's the dashboard looking like?
So first, really, for us is make very clear that we drive revenue, revenue growth. Cost efficiency working very well. Large deals sort of underwrites that. And then look at where are clients on digital cloud, generative AI transformations. It's a question of being with clients in the forefront. As soon as their thinking on that changes, we want to be the first ones to benefit from that, hopefully. Then the margin is critical. We see a real strong foundation with the program. We want to continue with the emphasis on employees. We've announced various compensation increases, leadership plans, that goes on. And then making sure that our brand becomes more and more in the forefront for the right things.
M&A, is that likely to be part of the plan?
M&A, yeah, absolutely.
And any specific areas that you would like to focus on?
As we've sort of shared earlier, there's an active pipeline. There's a look at strategic fit. There's also a look at cultural fit. We think our integration in the last 4 or 5 years have gone quite okay. We want to make sure there's obviously financial sort of sanity, and there is now in what we're looking at more and more in the valuations. And then there are good areas, so we could look at some geographies, we could look at some service offerings, we could of course look at some of the newer areas. We just announced last week, you might have seen something in engineering design, a small acquisition, and those types of things in different areas will continue on.
So smaller tuck-in acquisitions, and any specific geographies that you're targeting?
Geographies, firstly, it'll be small and mid-size as well, so there's no sort of constraint. And geographies, US is very strong for us, so we will continue there. And of course, Europe, there are places where we've done very well. And so we will further expand in that area.
So do you believe on the back of the visibility that you have today, the conversations that you're having, that perhaps growth may have bottomed out?
That, we have no way of saying. We are really very carefully, discussing with clients on when that transformation spend comes back. As we see that, we will of course share that with you.
Well, Salil, it's always a pleasure. Many thanks for joining us here in Davos. Appreciate your time. We wish you the very best of luck for the year ahead and look forward to hearing more from you through the year.
Lovely. Thanks very much. Shireen.
Well, we are going to take a break here, but the conversations will continue. We're back in a moment. That was Salil Parekh of Infosys. More coming up on CNBC TV 18.
Okay, 500 on the Nifty, nearly 2,000 on the Bank Nifty. That's where we are at. Mayuresh Joshi, Head of Research at William O'Neill, is with us. Mayuresh, quick view, is sort of counting down to the close now, 5-6 minutes. But HDFC Bank, what would you do?
No, afternoon, Prashant. No, we'll wait it out. I think the market is clearly giving a reaction in terms of numbers. And obviously, I think as the discussion meanders around how the deposit mobilization might or might not happen over the next couple of quarters, having a look in terms of what kind of adjustments need to be done to probably even maintain that liquidity coverage ratio, along with the increase in risk-weighted assets and the slippages which have increased. Obviously, if deposits have to increase at the pace at which the street probably believes in, there is going to be a compression on NIMs. And that is clearly getting reflected in terms of price. So we'll wait it out, Prashant. I think let's see how the other banks probably report numbers and then probably take a call on this.
By the way, we've been talking about what is down and out because everything it looks down and out, but it is not the case. The entire PSU space, not the entire PSU space, but maybe we can look at these names: IRFC, RVNL, Cochin Shipyard, IREDA, Hudco, there's Midhani, ITDC, Dredging Corporation. I mean, these 8-9 names doing very, very well. I mean, and these are large volume-led gainers, anything between 5 to 15% or so. Why not end on a slightly more positive note, Mayuresh? Any thoughts on these names out of the list that I mentioned?
Railway stocks moving at the speed of a bullet train, Prashant. And as we speak, I think the structural story probably continues. Decent order books giving them revenue visibility over the next 4 to 5 years. The execution has been super over the last few quarters. The margins at which these orders are coming are pretty decent as well, which means as they execute well, operating leverage obviously gets played out. Obviously, I think the risk factor that comes through is if they are not able to execute in the coming few quarters for whatever reason, and some expansion that is probably needed to execute this large order book at hand. Some of these stocks are also good dividend-paying stocks, but the run-up, Prashant, has been a little bit too much. We continue a few of these stocks like IRFC, RVNL, RailTel into our portfolios. We are riding the momentum as we speak, but I think fresh investors should probably wait for pullbacks. I think they have run a little bit too much for fun.
Mayuresh, thank you very much for joining in, counting down to what's been a very, very tough session for markets in complete bear grip. The Nifty down 450 points. At the day's low, we were down almost closer to a 500-point fall. The Nifty low today was 21,550. We're ending about 25-30 points above that level. But it's a smackdown. The Sensex down 1,650 points. At session lows, it was a near 2,000-point fall. The Nifty Bank is lower by 2,000 points, largely impacted by HDFC Bank. Out of the Nifty 460-point fall, HDFC Bank itself is contributing about 250 points on the way down. Throw in an ICICI Bank, and then you're adding on another 50-point of a decline. So it's these large banks where you've seen bulk of the selling.
Absolutely, but then there was profit taking in other parts of the market as well. I mean, metals, for instance, look at a stock like Tata Steel down about 4%, Hindalco lower because of the China data that came out and the huge fall that we were seeing in some of the regional markets. And then you have profit taking in autos, Bajaj Auto cooling off, a couple of other names on the downside, M&M as well on the downside. The thing is, even Reliance for that matter, I mean, Reliance, remember, towards the end of last week, we were talking about Reliance making a big move, but a lot of that has fizzled out this week, and today it was down 1%, so no support coming in. It was really IT, some of the top IT names managing a little bit of green, that also not too much. I mean, you've got Infosys, TCS on about a 0.5% rise, and that's about it. But Prashant, I like the fact that you pointed out the PSU rally. It's an alternate world. It's a different planet called PSU planet, right? Come what may.
Absolutely. And, we were talking about day before yesterday, I think we were mentioning how IRFC is now almost 2 lakh crores in market cap. Yeah. I think maybe we should check after today, it would have crossed or maybe almost there, the 2 lakh crore market cap number. But just amazing, I mean, what we've seen in that space, even as the rest of the market has been, sullen today, all day. 450 points lower, 21,578. By the way, as of yesterday, if you take the 20-day, which that is, it's that comes in at 21,622 or so. So basically, we've ended. The provisional close about 50 points under the 20-day moving average. All day today, we've said we need a conclusive close below the 20 days. 50 points on a 21,000 index conclusive. Now that's I think, we'll of course watch global markets, etc. 50 points is nothing. I mean, but as I said earlier as well, once you do get a firm sort of handle below the 20-day, in previous instances, at least 4 instances have resulted in between 5 to 10% declines, pullbacks. So that's where we kind of find ourselves at. But more on this later. It's a wrap on this edition of Closing Bell. From all of us here at Goodbye, markets forward will pick on all the action in just a bit from now.